Hello, good afternoon. My name's Laura McCabe. I'm the Director of Marketing for Sal Management, and it's my pleasure to be a producer of the webinar series. A couple housekeeping items, and then I'm going to turn the program over to Jason Inglis, our Chief Revenue Officer. Today's program will be recorded. It is available on demand using the same link that you used to log in to the webinar. And then I'll also email the link in a couple days from the platform. We'd also like to encourage you to ask questions throughout the program. We really want you to get the most out of the presentation. So please make use of the Q&A panel. And with that, I'll turn it over to Jason Inglis.
Thank you, Laura. Good afternoon, everybody. And thank you for joining us today. I think you're going to be very happy you did. For those of you who I don't know, as Laura said, my name is Jason Inglis. I'm the Chief Revenue Officer here at Sal. As CRO, I'm responsible for developing and implementing Sal's revenue growth plans. But I also have the great privilege of being involved with many of Sal's strategic partners. So as you should know, or hopefully recall, one of our overarching goals here at Sal is to provide our advisors with the tools that they can use to run a successful advisory business, but also provide advisors with access to our partners like First Trust. First Trust is a phenomenal partner with Sal. In many ways, they do the seemingly impossible. They can help make advisors' lives easier by simplifying investments, specifically alternatives. But that's really just the tip of the iceberg with First Trust. They do so much more, and they have amazing resources. And so that's really the backdrop for today, because I'm very excited to introduce Bryce Gill. Bryce is an economist. He's part of the First Trust economics team. And actually, Bloomberg ranked as one of the top forecasters in the U.S. economy over the past several years. So congratulations, Bryce and team. At First Trust, Bryce is responsible for analyzing economic indicators, writing economic commentaries, and producing articles on the First Trust economics blog. He's also one of First Trust national speakers. So he travels around the world to present timely information on the economy and the financial markets to both professional as well as everyday investors. So we are very, very happy to have Bryce here with us today to share his insights. And with that, I'll turn the mic over to Bryce, who will take you the rest of the way. So please join me in welcoming Bryce Gill to the webinar. Bryce, the floor is yours, my friend.
All right. Well, hey, thank you so much, Jason, for the introduction. Thank you, Laura, for setting this all up. Thanks, everybody, for hopping on the call with us today. My name is Bryce Gill. I'm one of the economists at First Trust Portfolios. It's obviously a great time to do an update like this. And I've been an economist for a little over 10 years now. I sort of think of my career as there's the pre-COVID days and then there's the post-COVID days. Things have been a lot more interesting since the pandemic, and we're going to get into a lot of those interesting things today and how they've changed the economy and how they've injected volatility into the markets and kind of what to expect going forward. But hey, just a week ago, we had Donald Trump reelected to the presidency in the United States. And so the past week has been filled with a bunch of very interesting news around, appointments to cabinet positions, about economic policies that are likely to be implemented under a second Trump administration. And, when we look at this election, Donald Trump won, I think it was 312 electoral college votes. This is sort of being characterized as a landslide victory. And I want to put things in context and say, we've seen much bigger or more significant victories in the past, right? Like Barack Obama, I think, had over 400 electoral college votes. Ronald Reagan had over 500, right? So we've seen bigger landslide victories in the past. But that all being said, in today's day and age, when we have this very polarized political environment, elections are pretty much 50-50 all the time. When you see 312 electoral college votes and then also a winning of the popular vote, I do think that the Republicans, and they're, by the way, coming in with the House and the Senate as well, have a huge mandate for change over the next 4 years. I mean, they are going to be able to implement a lot of Donald Trump's agenda. And obviously, those economic policies being implemented are going to have big implications for the US economy and the stock market and everything else. And so I want to focus today on just some of the major policies you're likely to see. So we'll talk a little bit about the trade policy, right? The tariffs, the reshoring that's been going on. Talk a little bit about the illegal immigration situation. I think both those pieces of policy play into inflation in probably a pretty significant way. So I'll talk a little bit about that. Talk a bit about the deregulation that's likely to happen. Maybe add some historical context there, show you kind of where we're at in the United States and what to expect going forward on that front, because I think we're very likely to get some major deregulation here in the near future in the United States. And then I'll just wrap up with some thoughts on the tax cuts that Donald Trump is proposing, and the likelihood of them being implemented. And I think that ties in with the federal budget situation, where we're at with regards to the budget in the United States. And that should cover most of our bases with regards to big economic policy changes. Kind of, I'll put a bow on it at the end about what to expect with markets maybe here over the short term, and then we'll have plenty of time for Q&A at the end. So if you have something that's top of mind that I don't get to, or that you'd like to ask a question about, please feel free to do that. I can't guarantee that I'll have an answer for you, but I'm happy to do my best to give you one. So with that, I'm going to go ahead and put some slides up on the screen here, and we can get into it here. So, and these should be popping up on your end there, Jason. Can you see this okay? Just want to confirm.
Yes.
Okay, beautiful. So listen, guys, I think we should start with inflation and the trade policy that we're likely to see under the Donald Trump administration. And Donald Trump was elected in 2016 the first time. A major part of his party platform was bringing American jobs back home. I think Donald Trump basically has been elected twice on kind of two different, I guess, like veins of public support. The first is basically a backlash against globalization and offshoring over the past 30 years. So obviously trade policy plays in all of that, and we'll get to that here. I think another part of this is just like an anti-establishment sort of feeling in the United States. People, after the past 20 years of the invasion of Iraq and Afghanistan, and then the 08-09 financial crisis and the really poor economic recovery from that. Then we have COVID, then we have the Russia Trump collusion story that gets everywhere. People are just feeling like less and less confident in what I would say the establishment. And so I think Donald Trump, kind of soared to re-election on some of those feelings as well. But what you have to understand about the U.S. economy over the past 30 years is that, we became more and more integrated with the rest of the world, right? So the last time inflation was really high in the United States, it's the late 70s, early 1980s. Paul Volcker is the Federal Reserve Chair at the time, so some people might remember his name. He raised interest rates to 20% plus in the United States, and he gets a lot of the credit for fixing inflation the last time around. My view is it wasn't really Paul Volcker that fixed inflation in the United States. What fixed inflation in the United States was globalization. We saw the Soviet Union collapse. We saw China join the WTO. And when you think about it, in the grand scheme of things, like half the world joined the Western markets in a very short period of time. So in America, like in the span of 10 years, we got access to a ton of cheap labor and materials all over the world. And so businesses saw this situation, and the US government saw this situation, and they realized, well, hey, our biggest expenses come from labor costs. And so if we can move the factory to China, it's going to be great for our profit margins, right? We don't have to pay as much for labor anymore, so profits go up. It's also going to be really good domestically for consumer prices. We can use the cheap labor abroad and then pass on all those cost savings to the end consumer. And so that was sort of the deal that was struck. Businesses got higher profit margins and consumers got like cheaper consumer goods. And, the trade-off to all of this was that the United States just saw a lot of its industry migrate abroad. Our supply chains got really long and complex, but they also became, fragile as well. And so during COVID-19, what happened was these really fragile supply chains fell apart. And so, Donald Trump, again, he sort of like started this political trend of wanting to bring business back to the United States. But what we saw during COVID-19 was, hey, this reshoring of supply chains idea becomes really bipartisan. Okay. And when you look at like the election we just had, both candidates wanted to continue to incentivize business to come back to the United States. Donald Trump started this trade war with China during his first term. He raised tariffs against a lot of countries. Joe Biden has not removed any of those tariffs. All that stuff is still in place. And so, we've seen this issue of basically bringing business back to the United States become completely bipartisan over the past, 2 or 3 years. And this is a significant change because, it's a complete reversal of U.S. policy over the past, 30 or so years before that. And so to show you guys that this is not just all political rhetoric, that, we are actually seeing some major changes, what I did on the chart here is I pulled data on U.S. Census Bureau construction spending. So the U.S. Census Bureau keeps track of construction spending in every major industry. What this line shows is spending on manufacturing facilities. Or like another way to think about this is just how many factories are being built in the United States at any given point in time. And you see, hey, we get out of this COVID pandemic. In the past year and a half or so, factory construction has more than doubled in the United States in a very short period of time. And when I go back in time, I try to like find a good comparison point. This is the fastest growth in factory construction probably since World War II. So we are becoming more self-sufficient. We are bringing business back home. But the trade-off here is that it probably is just going to be a little bit more expensive to pay Americans to make all of this stuff. And so my guess is, hey, now we have a new Trump administration coming into office. Obviously, they raised tariffs the first time around. I think tariffs are probably back on the table as a negotiating tactic to get better terms of trade from other countries. I think the United States is going to continue to incentivize manufacturing to come back home to shore up its supply chains. And Donald Trump has obviously talked about multiple ways to do that outside of just the tariffs. He's talking about like a lower corporate tax rate on manufacturing companies and things of this nature. So we're already seeing one of the biggest reshoring booms in modern history. And I think Donald Trump is obviously good for that trend as president. He's going to continue to incentivize that to happen. So the benefits here is, again, we're more self-sufficient. We don't have to worry as much about China or Taiwan or like Russia or, whatever other country abroad potentially cutting off the supply of goods or services to us. However, the trade-off is, hey, it's probably just more expensive to pay Americans to solve to make these things in the United States. And so the Federal Reserve has started cutting interest rates, and most people are aware of that. The Fed also wants to see 2% inflation to continue to follow through with rate cuts for, the foreseeable future, which they're saying they're going to cut rates for the next 1.5, 2 years. I think Donald Trump is basically the faster growth and higher inflation candidate here. Raising tariffs is probably going to add a little bit to inflation. I also think the crackdown on illegal immigration is likely to raise inflation as well, because the past 2 years, we've seen so many people come across the southern border. They've swelled the labor force at such a rapid rate. Normal people don't have as much negotiating power when they go to ask for a raise. If that situation changes significantly, and I think it will, with regards to this border czar that's been appointed, with just the executive power that the president has to actually change that situation on the southern border, I think what you're going to see is illegal immigration slow down considerably. That means domestic U.S. employees have a little bit more negotiating power. They can ask for higher wages. And ultimately, what raises inflation over the really long term isn't just like groceries and gas prices. And those are kind of what's covered most in the news. What really drives inflation over the long term is pay increases, right? Especially if people are making more money without like producing more. And so my guess is, hey, we probably see inflation accelerate a little bit just from the crackdown on illegal immigration and, higher tariffs. So again, I think Donald Trump's the kind of higher growth and also a little bit higher inflation candidate going forward. That would be my guess. Expect more restrictions on trade. But we also get something out of this, right? We get more self-sufficient supply chains as well. And, we've already begun to see a giant factory construction boom in the US, which this chart does a good job of showing. So, guys, I think another major, and I mentioned this, right? It's not just the backlash against global trade that's kind of driven a lot of support for Donald Trump over the past, 8 years or so. I think part of it's also been this like anti-establishment feeling, right? And what we just have seen recently, I think it was 2 nights ago, Donald Trump has basically said Elon Musk and Vivek Ramaswamy are going to be running a new department of the federal government called the Department of Government Efficiency. Okay, and the idea here is to just have a government office that goes through and gets rid of old regulations or regulation in general that's unnecessary. And they're also looking at doing significant cuts to the federal bureaucracy as well, right? And so to kind of put some of this in context, because when we talk about regulation, it's one of those things that's difficult to really discuss in like a grand scale, right? So I can always get up here and I could tell you about one regulation or another, or kind of the effect of one regulation on the economy. But when we're talking about like the idea of deregulating the economy, I think it's kind of hard to wrap your brain around sometimes because we're talking about repealing lots of different rules, right? Not just like one thing or another. And so one of the best ways that I've found to look at the overall level of regulatory burden in the United States in sort of a simple way is this chart right here. And what this is the number of pages, total pages, in what's called the Federal Register. And what the Federal Register is whenever a law is signed by Congress or a regulation or rule is signed into being by like the bureaucracy or different federal agencies, all of the stuff is compiled in one place. You can almost imagine it as like one giant book somewhere, even though it's obviously all digital at this point. And this one giant book is called the Federal Register. So by just looking at the number of pages in this thing, you can kind of have a general idea, especially looking back through history, at the regulatory burden of the overall United States. And so that's what we have a chart of here. And the first thing I'll say, guys, is, this isn't the first time we've discussed cutting regulations significantly in the US. One of the most successful examples of doing that was actually a bipartisan effort between Jimmy Carter and Ronald Reagan back in the late 70s, early 1980s. And the reason they were doing that is, they wanted to help deal with the inflation problem that was going on. So, when you cut regulation that's unnecessary, you basically make people able to do their jobs more easily. They're more efficient. They can produce more for the same hour of work. And when that happens, it helps counteract inflation to a certain degree. And so at the time, we saw, regulations and rules in the United States cut by probably 40-something% from peak to trough. And you see that big decline that happens under Carter and Reagan. So this is something that we did before. And by the way, this was a successful effort ultimately. You didn't see it till like years in the future. But the 80s and the 90s were very strong periods of economic growth for the United States. We saw something similar, maybe not as large of a degree, but early on in Trump's first term, deregulation was also a part of his platform. You can see the big decline that happens over the course of like a couple of years there early on in Trump's first term. The problem is, fourth year that he's in office, we have a global pandemic. Now, obviously, the COVID-19 pandemic comes along with a lot of new government rules and regulations, right? And so the combination of like COVID-19, this pandemic, and then the Biden administration getting in office, also adding some regulations to the books, we've seen most of the decline early on in Trump's first term reversed at this point. And so I think going forward, you're going to see another big cut to the number of rules and regulations in the United States. And, this is something that obviously Trump was able to do the first time around. So I sort of believe him when he says he wants to do it again. But also, we've got competent people like Elon Musk and like Vivek Ramaswamy saying they want to spearhead this effort as well. And by the way, there's been major Supreme Court decisions recently that seem to really help with this effort. So the one I'd highlight is the Chevron decision. And Chevron decision doesn't really have to do with Chevron, the oil company. What it has to do with is, the federal bureaucracy, okay? And in the United States over the past 20 to 30 years, what we've seen is a lot less rules and regulations being passed by law, essentially like Congress or our elected representatives vote this stuff into being. And a lot more of that regulatory burden has been shifted over to like the federal bureaucracy. Okay. So like the EPA or the FDA or the SEC, these like regulatory agencies will write regulations and then enforce them. And so what the Chevron decision said was that if you're going to pass rules and regulations in the United States that have an economic impact on individuals or companies or whoever, those rules and regulations need to be passed by law. Essentially, elected representatives need to make those rules and regulations because otherwise, we, the people in the United States, don't essentially have like recourse to reverse those decisions. If you don't like a rule that was passed at the FDA or the EPA, you can't vote them out of office, right? And so the idea here is, hey, a lot of these laws that have been passed by bureaucrats over the past 20, 30 years are essentially unconstitutional after this Supreme Court decision. And so that creates a pretty fertile ground for a deregulation effort to happen. I think we are likely to see something similar to like the Carter and Reagan deregulation occur in the United States. Again, back then they were doing it, it was helping inflation. I think this time around it could be a similar thing, right? If you're able to get rid of a lot of rules and regulations that don't add value to the United States economy or just kind of holding back the free exchange of goods and services, this could increase productivity and help solve our inflation problem, help offset, some of the tariffs, some of the crackdown in illegal immigration. So I do think this is likely to occur going forward. They are also talking about a big reduction in the headcount of the federal government. So some people have talked about as much as like a 50% reduction in the bureaucracy. The way they would do this is what's called like a reduction in force. Essentially, it's just a mass layoff of the federal government. And so a lot of people hear this and I think are concerned about this potentially causing like a recession in the United States. And I was looking at the numbers recently. We have about 3 million federal employees. I strip out like the postal workers because this is about the bureaucracy. I don't think anybody wants to fire the postal workers here. You have about 2.4 million bureaucrats in the federal government. If we fired half of them, that's 1.2 million people. And by the way, everybody would receive severance pay, so nobody's missing their mortgage payment or their car payment or their kids are still going to school, right? So this looks like there's be generous severance packages. But even if that didn't happen, 1.2 million people, that's a lot of people, right, in absolute numbers. But the United States labor force is, 170 million people are currently employed. And so when you really look at the numbers, firing 1.2 million people doesn't even raise the unemployment rate in the United States 1%. These are highly educated people. They would be able to find new jobs somewhere else, I think, very quickly. And ultimately now, hey, they're creating something that the market wants instead of, just rules and regulations that sort of bog down the economy. I think ultimately this deregulation effort, it's kind of the thing that I would say I'm personally most optimistic about that I've heard from the Trump administration. I think this has huge positive potential if they're able to execute it on it well. And by the way, again, there's a historical context for doing something like this. Reagan and Carter, we then had the 80s and the 90s, which were very strong times economically. So I do think they have a mandate for change. I think they have the legal justification to do it. They put pretty serious people with regards to like Elon Musk and Vivek Ramaswamy and they started a new federal agency to oversee all of this. So I do think we're likely to see a lot on this front going forward. So with that, guys, let me talk about the last thing here, which is the situation with the federal budget. Okay. because in some ways, I think this is Donald Trump's and his administration's biggest challenge going forward. And I think this kind of dovetails pretty well with the tax cuts that are being proposed. So next year, a lot of the individual portion of the Trump tax cuts sunset automatically. Donald Trump's also talking about, no longer taxing tips or overtime pay. He's also, talking about cutting the corporate tax rate further. And so there's a lot of talk about tax cuts, right? Um, in the past, politicians have been able to get into office and just cut taxes and not cut spending in tandem with it. And obviously, this increases our deficit and our debt. But over the past 30 years, that hasn't mattered because interest rates have been falling. That's no longer the situation, right? And so I don't think the best way to think about the national debt is to look at the overall level of debt in the United States. That's like the national debt clock that most people have heard of. I think the best way to do this is to look at interest cost as a percent of GDP, okay? Because we're never going to have to pay off the entire debt. We just have to service the debt. We have to make the interest payments. And what this chart I have in front of you shows is essentially, how much of overall economic production every year in the United States do we just spend on interest payments? And so, again, the past 30 years, this deficit's expanded, but what you see is interest cost as a percent of GDP was falling consistently that entire time. We basically added debt and then refinanced it all at like a lower interest rate. And so even though we added $30 trillion of debt, interest as a percent of GDP was like historically low. So it's not surprising me that politicians just didn't really care about the debt or the deficit. And again, you just saw a lot of them come into office and like cut taxes and hey, whatever, right? Like, there's no reason to cut spending in tandem or to make up that revenue somewhere else and, worry about the deficit. Well, recently, because of inflation, because of interest rate hikes over the past 2 years of the Federal Reserve, not only are we adding to the debt, but we're also refinancing that debt at a higher interest rate. And you see what's happened with interest payments, they've surged significantly here over the past couple of years. One of the biggest reasons the deficit itself has expanded so much is just the interest costs have gone up so much because interest rates are higher. And so today we're spending $1 trillion a year on interest. That's bigger than the defense budget or Social Security or Medicare or Medicaid. It's the single biggest line item in the US federal budget. And so, if we want to do a big corporate tax cut, I think you basically have to offset that loss of revenue by cutting spending somewhere else, by raising tariffs or taxes somewhere else. You can't just cut taxes without doing something to make up some of that revenue. Now, some of the smaller things like not taxing tips or overtime pay, that ends up costing the US government very little. I think it's very popular. I think, by the way, it's probably good for the economy as well. Most of that money is going to, working class people that will use it and spend it more wisely than probably the federal government will. And by the way, like nobody reports their tips anyway. So I don't think the federal government's really losing any revenue. Those are very popular positions. It's when we talk about like cutting the corporate tax rate, I think that's going to be difficult to do without offsetting some of that with spending cuts. So again, they're talking about reducing the federal bureaucracy, reducing regulation. They're talking about maybe cutting spending in certain ways. I think that's going to happen to get all these tax cuts renewed in the United States. When we look at the stock market, guys, what really drives the stock market is a combination of revenue and earnings, and then interest rates. So like how fast companies are growing their earnings, their profits, and then the discount rate is the interest rate that we use to figure out like how much we should pay for those earnings. And so interest rates and profits, that's what matters when we talk about financial asset values. When we talk about earnings here, like things look pretty good to me. I think, again, Donald Trump's like the high growth, high inflation candidate. That's good for companies' earnings and revenues. Those will just go up faster. When we talk about interest rates, I think it's a little bit more difficult of a picture because on one hand, hey, higher interest or higher inflation probably means the Fed can't cut as much going forward. I think they are going to have trouble getting to 2% inflation with the tariffs and the crackdown on illegal immigration. Maybe they can offset some of that with better regulation and things like that. But on top of kind of the concerns I have around inflation making a bit of a resurgence, and I'm talking about like 1 or 2% higher inflation, right? I don't think we're going back to 9 or 10%. Find that very unlikely. But I think another concern here is that, hey, when the Federal Reserve started cutting interest rates at the short end of the curve, like short maturity, right? Like interest payments or the interest rates long out, like 10 years plus, actually rose, even though the Fed was cutting rates. And the reason that happened was investors are looking at the US Treasury market and saying, hey, the US government's budget situation kind of looks shaky. We don't feel really comfortable investing unless we get a higher interest rate. And so I think one of the best things that Donald Trump could do for the stock market for investors is put forward a plan to actually address some of this government spending, some of these debt and these deficit issues. If he did that, I think it would be really good. It would cause long-term interest rates to fall. It would help make this picture right here look better immediately. And on top of that, lower interest rates longer out on the curve would be good for the stock market too. Where I'd be worried is if Donald Trump tries to ram through a giant corporate tax cut without making up that revenue somewhere else. I think that could cause long-term interest rates to rise and potentially cause problems for the stock market in the future. So that's one of the biggest things I think we should look out for is, do they try to pass these tax cuts, and do they try to pay for them or make up that revenue somewhere else by either cutting spending or raising taxes elsewhere? If they don't, that's where things I think potentially get a little bit risky for the market. As we stand here today, if they're cutting regulation, the economy is going to grow faster. We're going to see more investment. All those things are positive. So it's really the budget situation that's going to be the biggest challenge, I think, for this administration. It'll be interesting to see if they're able to put forward a plan that works. And by the way, guys, in the 1990s, Bill Clinton and Newt Gingrich got together. They made a bipartisan deal on this. That's the last time interest costs were this high as a percent of GDP. I think there is an incentive for politicians to maybe work together a little bit here. And so I do think we see, some effort to address this, which is the good news. So with that, I'll go ahead and wrap up and say, thank you so much for spending some of your afternoon with us. I've got a couple examples of the pieces we put out at First Trust, Monday Morning Outlook, 3 on Thursday. If you enjoy this type of material, I would suggest you look into following some of this stuff. It's all free. It's 1 page or less. It's easy to read, easy to share. I think it's a good resource. I've got some ways to do that on the screen here. So with that, though, I'll go ahead and end prepared comments. Let's do some question and answer.
Yeah, thank you, Bryce, and everyone. If you want to ask a question, there's a Q&A button down at the bottom where you can type it in, and we can talk about those questions. I'll sort of start you off with one. You talk about the budget, the government budget, and what do you think is the best way, or how could we fix the government budgeting, and then sort of how likely are those things to occur? Because we can talk about it from like a sort of economic theory type of standpoint, but what do you think we could do to fix the U.S. government budgets, and then how likely do you think that would be that they share your opinion?
Yeah, well, I think this is the biggest challenge that they're going to face here. And the reality is, like, the federal budget in the United States, 65% of the money that we spend goes to Social Security, Medicare, Medicaid, right? It's the big programs that people have paid into, and this stuff is driven by demographics, right? We just have like an aging population. People live longer than ever before. People have had less kids over the past 30 years, so there's less people paying in and more people living longer and taking out. And so that just expands the burden of this portion of the federal government budget. And so, you can do some things outside of touching Social Security, Medicare, Medicaid to deal with the budget. I'll talk about those in a second, but the single easiest thing you could do, and this won't happen, this is about a 0% chance of happening. So, I don't think we have to spend that much time on this, but you need to make like a deal between the generations where you say like, hey, millennials, we're lifting the cap on your contributions. So you're just gonna have to pay more tax on your wages into Social Security if you make more money. And then at the same end of the spectrum, like baby boomers, if you are a wealthier individual, we're going to means test your benefits and you're going to receive less. And that would take a lot of pressure off the system, I think, generally speaking. I think it's a really hard deal to make. I don't think it's going to happen. So you look at other portions of the budget, defense probably isn't getting cut. That's if the world's getting kind of more dangerous there. Um, what you could do is cracking down on illegal immigration, I think does help the budget situation short term. Depending on what source you look at, the United States is spending between $250 billion a year and like $600 billion a year on illegal immigration. So the reason, by the way, guys, that band is so wide is it's like if you just look at like direct payments, so like how much are we spending on housing people directly or food or shelter or whatever, that's where you get to like 250 billion. But then you got to think like, hey, people are using emergency rooms, they're using the school system, they're using a lot of like public resources and overburdening these public resources in certain places. They're not really paying taxes for any of that. If you include all those kind of like other costs in, that's where you get kind of like a higher figure. So it's really hard to narrow it down, but I do think we save a lot of money on that front. So that's kind of one way you could do it. Another thing that's been happening, Jason, is the Biden administration has been forgiving a ton of student loans. And by the way, like I know this got challenged at the Supreme Court and kind of got like shot down, but it's still happening in sort of a roundabout way. And basically, when the federal government decides that, hey, we're going to forgive this loan and we're going to give up this future revenue, they have to book that as like a cost in this year, right? So that's another thing that's added a bunch to the deficit in the past couple of years. So I think just reversing like the student loan policy, dealing with the illegal immigration situation, cutting some federal bureaucracy. I think Donald Trump's talking about like getting rid of the Department of Education. That's not like that big of a part of a budget, but I think what it does is it essentially shows like, hey, we're making some hard decisions, and maybe that's enough to add some confidence here. And just some added confidence on like the budget situation is going to cause long-term interest rates to fall. And if interest rates fall, it's going to take a lot of pressure off the deficit as well. So I think there's like several things they can do. It's kind of a confidence game. It's just putting things forward and sort of like following through on them.
Thank you. Thank you very much. I've got a couple questions that have come in. I have a follow-up, but I'm gonna leave that and let the advisors who chimed in jump in front of me because I'm just a gentleman. It's just the way it works, Bryce. But
Yep.
no, we have a question that says, can you elaborate on the policies you're hearing coming out from the Trump camp regarding China?
Yeah. So, man, there's been so many different ones that like it's hard to really say. You know, they're basically the biggest thing is going to be like, hey, we're going to raise tariffs on you, right? We're going to raise tariffs even higher. We're going to try and block a lot of Chinese imports. And this is anything from like a 10% increase in tariffs on China to like, I've heard like 60% increase in tariffs on China, right? So this seems like to be the biggest part of the trade policy here. My guess is a lot of this is just like a negotiating tactic. I don't think we're actually going to put like a 60% tariff on China. Tariffs are taxes on American consumers, okay? They make it more expensive for us to buy things, but the whole point of it is to like incentivize the production of those things to come back to the United States, right? To avoid the tariff, you make it here instead. And so, I think if we want to like do targeted tariffs, it makes sense, right? If we want to like make sure semiconductors are made in the United States or like, we're going to do a green energy transition and we want to make like windmills and solar panels here, that type of stuff makes sense to me, right? Just putting a blanket tariff on like of 60% on everything that comes out of China, like we're not going to start making cheap furniture and like Nalgene water bottles and like yoga pants in the United States, right? So I don't really see a lot of efficacy to doing that other than, hey, we're using it as a negotiating tactic to wring some concessions out of the Chinese government. And what would those concessions be? Probably things around like, hey, stop sending fentanyl into Mexico and into the United States. Maybe lower your trade barriers and actually allow us to sell directly into your country if you're going to sell directly into ours. Things of that nature, right? They're just trying to get some concessions from China. I think that's mostly what we're likely to see here.
And then just real quick on that, and I have another question that I want to get to. So just real quick on this, do you think when the tariffs, it's going to be mainly China tariffs, or do you think it's going to be tariffs that will expand to other importers or importing countries?
I think, yeah, I think the main focus is going to be on China. However, there's other countries where we have like long-standing kind of, I don't know, I'm trying to think of like the best word, long-standing kind of like contentions with their trade policy, right? So another one that Donald Trump's talked about is like tariffing like Mexican cars or something, right? And basically the idea here is, first of all, it violates USMCA, like the agreement that we signed under Donald Trump. So that's kind of a little bit of a difficult thing there. Again, I think this is the whole idea here is to one, get Mexico to kind of cooperate with the whole illegal immigration situation, right? And two, I think the idea is a bunch of like Chinese um, corporations have set up shop in Mexico, and they just like send over all the parts from China and like assemble them in Mexico and then like import them in the United States to avoid the tariffs. I think the idea is like, hey, there needs to be like a rule of origin, like a certain percentage of like whatever a car needs to be made in North America to be tariff free. So you can't just like make all the parts in China and assemble it really quick in Mexico and ship it in, right? So there's some other ones too. Like we've been angry at Europe for 60 years because they won't let us import like chicken and pork in there. Right? We have like certain industrial food ingredients that Europe doesn't want, and I frankly can't blame them. We have a lot of bad things in our food in the United States. So, but that's a thing that we have a problem with Europe is like, hey, let us import chicken, or we won't let you import trucks. That's been a disagreement for like 60 years. So maybe he does some of the stuff with Europe. I think the focus has really shifted more towards like China though at this point. And any tariffs that we put on Europe are going to be so minor that I don't think most people will even recognize them. Guys, you have to remember 70% of what we spend money on in the United States is services, meaning we pay each other to do stuff for each other, right? Those aren't really affected by tariffs. Now, maybe like you'd say, I'm paying somebody to do my nails. They have to get I don't know what goes into getting your nails done. So maybe it's a bad example, but like I'm assuming they import like all the acrylic nails from China or something, right? Maybe that costs your nail appointment to go up a little bit in cost, but most of the cost there is the person doing your nails. It's not like the actual acrylic nails, right? 30% of what we spend money on is goods, and only a portion of that 30% is imported goods, right? So when you raise tariffs on imported goods from like China, the actual implication for inflation is pretty small. Like we're talking about, it probably adds less than half a percentage point to like consumer price inflation that you see reported on the news maximum. And remember, guys, we did all these tariffs, and like he is suggesting bigger ones now, but we did all these tariffs under the first Trump administration. Inflation was like below 2% the entire time, right? So it wasn't even noticeable, I think, to most people.
Thank you. So I got two questions, and we're running short on time. So I don't know. I'll ask Laura if we could maybe go over a little over if people want to stay.
I'm happy to stay if you guys need me.
Well, I know we're bumping up on time, so I don't want to. Laura, what are your thoughts?
I think we should answer the questions for the people who have already put them in, and then we'll wrap up. So.
Okay, good stuff. So lightning round, we're at Bryce. So the question came in from an advisor: Can the new Department of Government Efficiency truly do mass layoffs with many of those federal employees being basically unionized? And what does that look like?
Yeah, it's a great question. So I think part of this goes back to what I was talking about with regards to that Chevron decision. So if you say like, hey, it turns out half the regulations are unconstitutional and we're repealing them, well then, it's sort of natural to also say, well, we also need half the amount of people to administer these regulations, right? And my understanding is, okay, it's very, very difficult to fire like an individual federal employee, right? To go and say like, hey, Mr. XYZ, like you're gone, because what the union can do is say, well, listen, you fired him for discriminatory reasons or because of his, race or gender or whatever, right? And so you get tied up in court with these types of things. If you do what's called a reduction in force, which is like essentially a mass layoff, and you're just like saying, hey, like, if your social security ends in like an odd number, you're fired. There's no discrimination involved with that decision, right? You're
Mm-hmm.
basically making like an administrative decision that we need less federal employees to administer like the bureaucracy. And so my understanding is that actually gets around a lot of the legal challenges from unions that would happen with regards to lawsuits. So I'm not saying it's going to be, they're going to go without a fight. They probably will. But I think that's also part of the reason for the very generous severance packages, right? Like we'll pay you for a year or 2 years, just turn in your credentials and go home. And then you
Yeah,
find a
so
new
more like a
job. Like
corporate restructuring.
yeah, it's a restructuring, right? And I think you can probably get away with doing that. And that's exactly why they've hired Vivek and Elon Musk to do this. They've clearly sort of thought up a plan here. And, if you're getting paid anyway, like, and you're going to find a new job, it's not spiteful, right? It's that we just don't need as many
Yeah.
people. So I think they can probably get away with that.
All right. And next question, real quick. Do you see a link between deregulation and corporate consolidation? That is, do you
Yeah,
think deregulation increases the risk of monopolization? Say that 3 times fast.
You know what? So I just saw this. This is actually a really interesting question because it's super timely. Like a couple weeks ago, there was a story in the Wall Street Journal that said that the Department of Justice is investigating 40% of the S&P 500, right? So
I saw
really
that.
almost like half of the companies in the biggest stock market in the world are under investigation by the Department of Justice. They're the ones, by the way, guys, that do like antitrust regulation. So when we talk about like corporate consolidation, the Federal Trade Commission and the Department of Justice are like really central to that. And there's a person called like Lena Khan who's been bringing a lot of these antitrust actions that have been like blocking consolidation in the corporate sector, right? So like I think like the Kroger Albertsons merger, maybe that is still going through. That one's been having trouble. I think like Spirit Airlines and like Frontier Airlines, that one just got shot down, right? So yes, like there is some like Department of Justice, like DOJ, like Federal Trade Commission, antitrust, uh, I guess actions that hold back consolidation in the corporate sector. And that's this lady, Lena Khan, has been kind of spearheading all of this. She was
Yeah.
appointed by Joe Biden. Um, my guess is she probably gets replaced by Donald Trump, right? So it's not so much deregulation as just like replacing someone in an agency. But at the same time, Lena Khan's bringing all these actions against tech companies, and Donald Trump hates the tech companies. So maybe he keeps her. I don't know. It's kind of an interesting question. But what I would say is, so yes, if you like deregulate or replace the DOJ heads, maybe it does help like remove some pressure from corporate consolidation. But my personal opinion, Jason, is like it's not like the DOJ or like antitrust that has been causing like or lack of enforcement that's been causing all the corporate consolidation over the past 30 years. I think a lot of that's been just been driven by low interest rates.
Mm-hmm.
Essentially, like if interest rates are zero and you're like Google or Apple, like why not just buy up the new competitor when they're still like small and you can just like throw money at the situation. And that's what they've done, right? Like all these tech companies become so vertically integrated because they buy up their competitors for like billions of dollars and just like
Mm-hmm.
integrate it into like the blob, right? And so, but that was driven by 0% interest rates and less so by like Department of Justice actions. And so now that we have higher interest rates, I think you're going to see corporate consolidation slow down in the United States. Um, there's been a lot of empirical research that's basically been done saying like 0% interest rates, one of the biggest downsides to them is that it hurts innovation in the country over the long term because you have all these like zombie companies that no longer go out of business. They just borrow more money and kind of keep shambling along. And you also have these like big incumbent companies that just use cheap money to buy up their competitors. And so it sort of like short circuits the creative destruction that makes capitalism so vibrant and effective, right? And so
Interesting.
I actually think higher interest rates are slowing down corporate consolidation more than like the Department of Justice or Lena Khan is. So it'll be interesting again to see what Donald Trump does with her. If he replaces her, it probably helps more mergers go through, though.
Well, thank you. I had one question come in right before the cutoff time, so I'm going to go ahead and read it. Again, I thank you so much for joining the call and answering questions. If people have to drop off, I understand. I'll ask you this last one. We'll run a little bit over, so I apologize for running over. But we got a question from an advisor. It said, you just made a comparison between Trump 1 inflation and potential Trump 2 inflation. Do you see evidence that the velocity of money is in a similar or dissimilar position when comparing the first 3 years of Trump 1? And what do you foresee in the coming Trump administration?
Yeah, so velocity of money is an interesting question. I think what we saw under the first Trump administration, big picture is, hey, we saw a lot of nationalist economic policies happen, right? And I think Donald Trump was better for like normal workers and probably was worse for like, what I'd call like, I don't know, the elites or like the investor class, right? Even though we all made money in the stock market, it's just like, hey, you had to pay your employees more, right? And so yes, in a way, this increases like velocity of money because when like, somebody at Chipotle's pay goes up, they go out and spend the money. Whereas like someone at Wall Street CEO's pay goes up, he saves it all, right? And so we saw like pay for normal people accelerate during the first Trump administration. I think we're likely to see that continue. It's been, by the way, happening since the COVID pandemic because all of a sudden we're reshoring all this business even faster. You can't just like threaten to move the factory to China anymore. So you have to pay your employees more in the US. So yeah, I think that's basically pay increases at the bottom of the income spectrum do increase velocity of money and like economic activity more so than like pay increases at the top do, right? And so when we look at like a chart of velocity of money though, and this may be like way in the weeds, so I don't know how interested this person actually is in it. The velocity of money has been dropping precipitously since like the early 1990s. And it's bounced back a little bit, but it's still like pretty low historically speaking. A big reason why we saw that huge drop off in the velocity of money was the collapse of the Soviet Union and the United States becoming the center of like this new booming globalization, right? What happened is all these dollars then go abroad and they're used as a reserve currency. They sit in bank vaults somewhere, or like Peru and Egypt want to do a business deal. They don't do it in Peruvian solas, right? They do it in dollars. And so these dollars just move between like foreign countries or they sit in foreign bank accounts and they don't really affect our GDP growth anymore. And so what that shows up as mechanically like velocity falls because a bunch of the dollars just go abroad. It seems like we're still the reserve currency. I don't know who's going to replace us. So don't expect like a huge surge in velocity like back to like 1990s levels. But yeah, I think if we crack down on illegal immigration, we see more reshoring happen, it means normal Americans see their pay rise more quickly, and that probably does boost velocity, I would say.
Okay. Perfect. Well, thank you so much. I appreciate you taking the extra time to address questions. Really appreciate your time and your insight. And like I said earlier in the call, this is what we've been trying to do with our webinars is take great partners like First Trust and the resources that they have like Bryce and get you to have a conversation with our advisors. So we really appreciate your time. I really appreciate everyone who jumped on the call and listened and asked questions. So thank you very much. Laura, I don't know if you have any other closing comments or if we just tell everybody to go on with their day.
Yeah, let's go on with our days.
All right.
Thank you to everyone for coming. This was a really lively discussion and I enjoyed it very much. And I hope everyone on the call also did. So
Thank you.
All right,
bye-bye.
thanks, Jason. Thanks, Laura. Have a good one.
You're welcome.
Bye-bye.